foreclose on the house, sell it, and get their money back. That hopefully won't happen, and most times it does. But if it does happen, there are some things that can go wrong. What can go wrong? If you're the bank manager, why would you lose sleep over this particular transaction? Well, what about if the house burns down, right? We'll call that disaster risk. A disaster can happen. And let's say the homeowner walks away. Well, what's that property worth minus the house? Maybe $100,000. What does the bank owe its depositors? $175. So who makes up the difference? Okay. So we'll talk about the risk, and then how the bank, being conservative, not wanting to take any risk, and wanting to try to mitigate the risk by having someone else take it or pay to take the risk away. Okay. So, disaster. Okay. What else can go wrong? Well, we can have default. Let's say the homeowner loses their job. Can't make the payment. Well, what happens? Well, the bank comes in, forecloses, sells the house. So part and parcel of this is, what about if housing prices go down? Right. So when the bank sells the house, they're not going to get the $175 back. So that's another risk. Fourth risk is one that relates to interest. Because remember, the bank is paying its depositors a percentage interest on the deposit. So you and I that put money in the bank, well, that money goes out to the mortgage. Right? So they're paying us as depositors interest, and then of course charging the customer more. What happens when interest rates change? This is a 5-year contract at a certain rate. So the risks to the bank are fourfold. And of course, the banks do not like to lose money. They don't want to take risk. And so they'll look at these risks and basically try to arrange things, since they're in the driver's seat, because I want the mortgage or the customer wants the mortgage, to try to see what they can do. Well, think about disaster risk. Well, isn't that what insurance is about? Okay. So if I get a mortgage from the bank, one of the conditions of that mortgage is that I pay for insurance. So homeowner pays, and who's the person on the insurance policy? Well, it's the bank. So if the place burns down, the proceeds of the insurance goes to the bank. Right? And then you have to negotiate with the bank as to what to do. Okay. So the disaster risk is mitigated through insurance, and the homeowner pays. So the bank doesn't care whether the place burns down or not, it's going to get the money. Okay. So that's the first risk. Second risk is one of default. Well, anytime you lend money, there's always a chance that someone's not going to pay. Well, default means foreclosure. A legal process that allows the bank to call up the sheriff, evict you from the house, take it over, and sell it. And timelines and what have you, miss one payment, they can't get you out of the house. That's a problem, but it's more of a problem if housing prices go down as well. Well, why are the two linked? Well, supply and demand. If, let's say, there's a downturn in the economy, and let's say the GM plant closes, and everyone's out, a lot of people are out of work, well, they're all going to be selling their house at the same time, and prices go down. So oftentimes, when there's an area that's being affected negatively by the economy, a lot of people lose their work, a lot of houses go on the market, and prices go down. So oftentimes, these two go hand in hand. Well, think about how you might get around that problem, or what is the problem? Well, let's just say housing prices go down. So let's say we've got someone, they've lost their job, and they can't meet the payments anymore. And around the same time, housing prices go down by 15%. Okay? So this $200,000 house now has a market price of $170,000. So the bank takes it over, forecloses, and takes the market to sell. So the best they can do is $170,000, but think about it. So new sale price. But think about selling a house. It's not cheap. right? You've got real estate folks who want a commission, you know, and sometimes it's as high as 5%. So they want 8,500. You know, you need lawyers, you know, and they're not cheap. You might want an appraisal to make sure that, you know, things are valued. Anyway, there's a series of expenses associated with selling a house, because of course the bank's not in the housing business, right? They want to get rid of it and turn it into cash, because they got to pay back their depositors. Then indeed, when you're finished, this is the net proceeds. Okay, so the bank's going to sell the house, it's going to get $158,000. Well, what's the problem? Well, the problem is that the mortgage was for $175,000. And let's say this happens 1 year into the mortgage. Well, like we talked about, one of the facts of life, the first year or two, you're paying virtually all interest. Therefore, the amount that this owner owes is still probably close to $175,000. So the bank gets $158,000 and has $175,000 worth of obligations, and it can't go back to its depositors and say, hey, sorry, we had a bad run on the bank here, we're not going to give you your money back. So the bank here is at risk. Bank managers don't like that. The banking industry doesn't like that. How does the bank get around this problem? The fact that housing prices can go down and that people can walk away. Any thoughts? What about the down payment? What can we do to the down payment to make this less risky to the bank? What do you think? That's right, because the problem is that the mortgage is for a very large percentage of the house. So why don't we say the mortgage can only be 50% of the house value? So you need to put 50% down. Will that work for people? Young couple coming up with $100,000 to buy a house? Not going to happen. It's a social policy in Canada that the working folks should be able to buy a house at a time when they need it, when they're young, building families. And having a 50% deposit goes against that policy. So that's not on. Is there any other way of dealing with it? Well, if it's part of social policy, perhaps the government should step in and do something. And the government in Canada has done that through the Canadian, and it's called the Mortgage and Housing Corporation, which is a Crown company that provides insurance. So think about this company, backed by the government, making good the difference. Well, who's going to pay? The bank's not going to pay. They don't like paying for anything. The homeowner's going to pay. And how should the homeowner pay? Well, ask yourself, what's the risk? Isn't the risk greater the less the homeowner has as a down payment? And in Canada, it's accepted that if the homeowner has 25% down, so a down payment of 25%, that the banks are sufficiently covered, because it's unlikely that housing prices will drop. So if you have 25 down, so if you happen to have, in this example, 50 grand when you bought the house, you wouldn't need insurance. Okay. So no insurance. You can borrow up to 95% of the house value, which means that you would have a 5% down payment. Well, if you had a 5% down payment, the law would require you to buy insurance, and your fee would be around 2.5%. So if you had a 7% mortgage, you're paying 9.5% a year. 7 for the interest, 2.5 for insurance. And it's a sliding scale. So if I had 20% down, there's less risk, right? Because housing prices have to go down by more than 20% to put the bank at risk, and your fee might only be 0.5%. And in between, it's a range. So the lower the down payment, the more the risk to the bank, the more the risk to the insurance company, therefore the more you pay. And again, it's backed by the government. So a lot of folks try to get 25 down if possible, because an extra 2.5% per year is very, very substantial. And so in this transaction here then, if it was a foreclosure, the bank would get 158 from the proceeds. Well, the difference between 175 and 158 would come from the Canadian Mortgage and Housing Corporation. So the bank hasn't incurred any expense, and that risk has been mitigated. And again, because social policy, people can buy houses with between 5 and 25% down and have it. So it looks like the bank, quite conveniently, has gotten out of this risk, and this risk at no cost to themselves. It's a great business to be in. The final risk seems like perhaps it's something that we can't do anything about. Let's talk about it. What's the interest rate risk? Well, most people will not borrow a mortgage unless there's a fixed term. Okay. We talked about the amortization period, remember, the entire 25 years minimum term. So let's say on this deal here, the 175 was borrowed for 5 years. So we have a 5-year term, and the contract was for 7%. Okay. Well, let's do a timeline. So over the 5 years, 1, 2, 3, 4, 5, this is now, I'm going to say the mortgage interest rate. Well, 7%, 7%, 7%, 7%, 7%. Fixed contract. Okay. Where does the bank get the money? Well, you and I deposit. And so the money, so this is revenue from the bank's point of view, and this is cost. Well, the cost is the fact that people have lent money to the bank or deposited it and expect interest. Well, for the sake of argument, let's say this. So the bank is paying 4% and expects to pay 4% on its money. Where does the bank make its money? Well, it's the middleman, right? Or middle person, I should say. The 3%. This is what we call the bank spread, or the interest rate spread. That's how the bank makes its money on these transactions. It's the middle person. It's in between folks who have money and folks who want money. This looks great. Not using the bank's own money, they're making 3% a year. But let's ask the question, what happens if inflation goes crazy and interest rates fall? And let's just say this happens over the next 5 years. What's the problem? Well, this is a 5-year contract. This doesn't change. So the bank is earning 7%, and that same money is costing 10. And so they're losing 3% a year. Not a good business to be in. That's what we call interest rate risk. And of course, the bank isn't in control. Right? The bank needs that 175 because it won't happen. Can the bank get around this problem? Because your interest rates go up and down, right? Any thoughts? How do you deal with it? Well, you might want to have a little bit of contingency fund in case it happens. Right? So rather than charging 7%, you may want to charge 8%, just in case. But if you try that, you'll find that you won't make any loans because all of the other banks are charging 7%. And no one's going to pay you any more than the going rate. So to have like a sort of insurance fee or what have you built in won't work. The only way to deal with those is to deal with the very nature of the problem, which is the bank has made a 5-year commitment. Therefore, the only way to make it risk-free to the bank is to get depositors to commit to 5 years. So what about if, when the bank makes this loan, they find a depositor that says, we'll lend you the money for the next 5 years under a contract where you will pay us 4%, i.e. a mortgage bond at 4%. So now, this is a fixed contract. And think about now what happens. Interest rates go up to 10%, doesn't matter. This depositor has agreed to take 4%. This person has agreed to pay 7%. Okay. So essentially, it now becomes totally risk-free from the bank, no matter whether interest rates go up or interest rates go down. They're making their constant 3%. So what banks do, and we use the term position, they do not take an interest rate position. In other words, they're fully covered. So if I can line up 5% 5-year money at a fixed rate and lend it out for 3% more on a 5-year contract, I'm covered. I'm not taking a position. Please.
So why would a depositor do that if they would end up making more money? Why would they sign a contract?
Okay. Well, because at this point here, there's a whole set of things available to you as a depositor. And you're saying, well, I don't think inflation's going to go crazy, and I'm happy with 4% a year, guaranteed. And you make out, of course, let's say if interest rates go down to 2 or 3%, then you're going to make more money, rather than having it floating. But if interest rates go up to 10%, then you're going to regret committing. So you as an investor make your forecast for the next 5 years and decide. What happens if everyone like yourself says, I don't want to put my money away for 5 years at 4%? Well, the bank can't make 5-year mortgages. So what do? Supply and demand. Don't they then start offering 4.5, 5, 5.5? And at some point you're going to say, based on everything else out there, getting 5.5% for a 5-year contract is really great. And money starts flowing in. But what does that do to this? Well, the bank still has to make its 3% to cover its costs. So mortgage owners, if you're going to demand 5.5, will be paying 8.5. And that's how market interest rates are determined in the marketplace. And you're going to now look at a product maybe that's 2 years that might only pay 4%. So you can decide, well, do I want to lock in for 2 years at 4, or 5 years at 5.5? Depending on what you think is going to happen, you'll make that decision. The interest rates will go up and down. As this goes up, there's going to be more money flowing in, right? Because the more sweeter you make it, the more people will go to 5-year terms. But as that happens, the mortgage rates go up, and then fewer people will want mortgages. At some point or other, you're in equilibrium. So in each market, 1 year, 2 year, 3, 5, there's equilibrium. And they're all different. Please.
Can you explain the fixed contract on that?
Sure. On this, you understand this side of it?
Yeah.
Okay. This side of it is like a term deposit. So the bank will say, give me $100,000. I will promise you 4% a year for the next 5 years, and then I'll give you your money back. So it's like a term deposit. So the bank is committed to me at 4%, no matter what happens in the future. As opposed to, let's say, a bank account where the interest just goes up and down depending on the market rates. Is that okay? So so the transaction would be, let's say, I would basically, end of year 0, give them, let's say, $5,000, okay? And they would give me that money back 5 years from now, $5,000. And each year, they would pay me 4%. What's that, $200? Okay. And we would call this a 5-year term deposit. So what happens if interest rates go up to 10%? Well, I signed a contract to 4. The bank just pays me the 200. Okay, so it's a fixed contract. So again, no matter what happens to interest rates, this stays the same, but the revenue stays the same. They make 3%. Please.
How is it 4%? So is it based on the interest? Is it equal to the interest rate?
The 4%?
Or is it based on how much the bank wants to make?
Well, the market basically determines both this and that. So this 4% is determined by what is the minimum rate the bank has to offer to get enough money, enough 5-year money, to meet the demand for its mortgages. And it won't pay 1/100 of a percentage point more. Right? So it's always, when we talk about supply and demand, we're always sort of, right on the margin. Like if we don't have enough money, we raise it a little bit, more money comes in. If we've got too much money, then we're paying too much, it comes down. And that happens constantly. So on a daily basis, the bank knows what the demand is for 5-year mortgages, and then will adjust its rate to make sure that it's got enough money. And then, of course, this 3% is determined by competition, right? They're not going to be able to charge 100th of a percentage point more for mortgages than other banks because no one will go there. Is that okay?
Yeah.
So it's, you know, we've got multiple banks in the system, and therefore they're all competing for business. And of course, we've got the smaller, I forget the term now, the trust companies and that smaller financial institutions that are also in the market competing here to try to keep this spread down. But it's determined in the marketplace in Canada. Okay. So think about now taking a position. What does that mean? Let's say the bank looks at this and thinks interest rates are going to go down. And so they're not going to get a deposit base that's fixed 5 years. They're going to let it float. So that sort of money, think about a bank account, when interest rates go down, the bank only has to pay 2%. So the bank says, over 5 years, we're going to sell this, but we think interest rates are going to go down. And they're not going to have a fixed contract, but they're just going to use money that fluctuates. Of course, they can make more money this way, because here they're making a 5% profit. But we call this taking a position. Because all of a sudden, the amount of money they make is a function of what happens to interest rates. If they're right, they're going to make more money than having a fixed contract at 4%. If they're wrong, and this happens, they're going to lose their shirts. So what you'll find, banks will strive very, very hard not to take a position. They're very happy with their cool 3% profit and not taking any risk. So this is the way it would work. So it would be a 4% deposit at 5% to back the mortgage. And so, no position. Okay. So these are the risks in the transaction. You know, once you lend money, of course, you're never certain that it's going to come back. Even though you have collateral, that collateral or that security may not be worth the entire value of the mortgage, and this is how the banks deal with it. And the government intervenes basically because of the social policy that folks, working class folks, should be able to afford a house without having a 50% down payment. Any questions? Please.
So the 7% is what we pay the bank?
That's correct.
And the 4 is what they give back to us?
Yes. So think about a depositor, like you've got, you either have money or you don't have money and need it. So if you have money and you don't need it and you deposit it, you'll get 4%. And if you need it for your mortgage, you'll pay 7%. That difference is the bank's profit for being in the middle. Okay, good. Okay, let me now just talk about, I guess, these last 3 topics I want to talk about, which is perpetuities, inflation, and we'll talk a little bit about bonds and how we value them. I have a series of cash flows here, basically going on forever. So a perpetuity tries to model something that goes on forever. And of course, in reality, nothing goes on forever. But it's a good enough model to try to approximate a long-term project. So think about a forestry project where we've got expenses for the next 50 years, but we're not going to harvest the trees for 50 years. So in that case, perhaps a perpetuity is one way of modeling it. Well, what is the error that's being introduced? Well, the real cash flows might look something like this. Up to year 50, right, when the project stops. Well, perpetuity says, let's model that with this. So in year 50, there's a cash flow, but in year 51, year 52, out to infinity. So the perpetuity overvalues because it adds these costs, an infinite number of them, from years 51 out to infinity. Okay, so you think that it wouldn't be particularly useful, because what we're after is the first 50. However, if you look at the present value factor once you get out 50 years from now, it's very, very small. And an infinite number of them is still small, so it's a pretty good approximation. And so oftentimes a long-term project will model with the perpetuity. University of Toronto, well, we expect to be around for a very long time. And so when we look at funding, we use perpetuity. When we look at a donation, we often ask the donor to basically fund it forever, right? Because we don't want them funding it for 20 years, because 20 years from now, we're going to have the problem to ask for money for the same thing. So let's fund it forever. Give us enough money so we can do whatever forever. Well, what does that really mean? It means that we will always have enough to generate whatever that costs. So look at that formula. Isn't that formula really this? Ask for the donation, the P, spend only the interest, and what does that mean? It means we never touch the principal. So this works because we're only spending the interest. So in the universities, billions of dollars worth of endowment. Endowment is just our pool of long-term funds that we've accumulated over the last 200 years that we invest. We very, very hard trying to always spend only the interest, never touch the principal. Therefore, this will go on forever. If I flip it around and say, well, how much money do I need to fund something forever? Well, we use the capitalized value. Okay, so what is the one-time lump sum capital amount I need, assuming I can earn I per year, to fund? Well, that's what that formula gives you. Now, it's a sort of an interesting situation because you think about long-term and you think about short-term, and the two are always in conflict. And we had a financial crisis at the university a couple of decades ago. There was a conservative government that got elected on the platform of the common sense revolution. Okay. And part of their platform was, we're giving too much money, too much taxpayer dollar to universities. Aren't the students at the university benefiting from being there, and shouldn't they contribute far more to their education? And their platform said the answer to that is yes. And almost overnight, funding to the U of T dropped by 25%. We're getting around $400 million, $500 million from the government. 20% of that is a huge amount of money. 25% of that is a huge amount of money. So what do we do? Well, of course, there was a whole lot of folks out there that says, well, we can't raise tuition. Right? We're a rich school. Let's just use the endowment to help deal with that. Okay. Well, President Pritchard at the time says, well, that endowment took the university 200 years to accumulate. Yes, it's billions of dollars. Yes, we're rich. But think about if we're trying to fill a gap of $100 million a year. That fund will run out in a very short period of time, given the fact we want to be around for a long time. So his answer was, no, I don't want to leave this place worse off from when I started. And how do you deal with a problem like that? Well, it's a short-term operating problem. Right? What do you got to do? Well, you got to cut expenses. And 25% cutting the university is not on. And you have to raise revenue. So, of course, tuition on the revenue side increased. And everyone at the university faced an 18% budget cut over 5 years. So you looked at retirements, you looked at folks who weren't pulling their weight, and you fired them, and you looked at other sorts of things. At the time I was in computing, we were writing down that information technology cost curve, and so we could upgrade equipment, and we saved money that way. But we're all looking for creative ways of not affecting the academic experience, but trying to shrink costs by 18%. And of course, we are more or less balanced. Well, not. We're about we spend $50 million a year more on $1 billion budget than we bring in. So we're almost there. Okay. So the idea was that on an ongoing basis, you don't want to spend a penny of this because it took 200 years. So yes, you want to spend the interest, but no, you don't want to touch the. So I've got an example just to show you how it works. And this is a sports team endowment example. And I was on varsity track, so I'm going to call this a track team example. This is a three-way meet. So the first year, we've got a meet in Toronto. Next year, we go out to Ottawa, and then we go out to British Columbia. You say the costs go up depending on the distance. And, this is a budget cut example. In other words, as part of that 18%, athletic department is saying, well, this is a thrill we can't afford. And of course, anyone who tracks it, this is a very valuable track meet that helps development my performance and want to keep it. So if the university is going to cut it, one way of keeping it is to find enough donors to keep it going. And the university's first position was, give us enough money so we can keep on doing this forever. Well, how much money does that take? That's what I want to do. Now, as a prelude to my discussion on inflation, have a look at those cash flows, and they don't seem realistic. Right? Because isn't the trip to British Columbia in year 6 going to cost a lot more than in year 3? Because airline prices go up. Okay. And so I've taken inflation out, okay, and I'm going to model it on that basis, but at the same time, I'm taking inflation out of my 5%. So what I'm doing here is I'm saying, well, let's take inflation out of the expenses, out of the earning in terms of the endowment, and it's a model. And I hope to show you, when I talk about inflation, it's a good enough model for addressing the question, how much money do I need now? And so that's what I've done. So this is taking inflation out of the picture. Well, let's go about it. And it doesn't look like it's obvious here that we're spending only interest, because this is what we're after. It can only last forever if we're only spending interest. I want to show you that that indeed is the case. But let's just see from an analysis point of view how we might do this. Well, first of all, let's ask the question, what does it take to fund the first cycle, the first three needs? Well, remember, our definition of present value is if we have a future obligation, the present value at the interest rate we can earn is how much cash we have to come up with to fund that. So I've got three obligations, the ability and the endowment to earn 5%, and so my P-given-F calculation says 22.7. So if I get 22.7, I can invest it at 5%, so the university is good at investing. I can basically meet those obligations and there'll be nothing left. So the first step in figuring out, well, if I want this to happen forever, goes like this. And here we're using that concept of equivalence, where if I have present values that are the same, even though the cash flows look different, they have equal value. So what about if I just ask the question, what's the present value of this, and find a uniform series that has the same present value? So in other words, have something that looks like this. That's equivalent in value. I don't care between the two at 5%. Okay? So one cycle costs 22.7, but that's the same as if I just do a 330 annuity, 83.59 a year. So the first part of it says these two are equivalent. 83.59. Okay. Well, if that's the case, then what about when I do the next series of track meets? Isn't that the case again? And if I want this to go on forever, there's the third one, I can have this go on forever. And I'm asking the question, one time period before the first meet in Toronto, what's it worth? Well, all of a sudden, I've got my perpetuity capitalized value equation. I've got a series of cash flows that are uniform that go on forever. I have the ability to earn 5% in this endowment. And therefore, we tell the alums, you need $167,000. Of course, you may have a heart attack. $167 for those three needs? But you're only spending interest, as I hope to show you. Please.
So basically, once you find the pattern for the cost, you just use the first pattern, and then you can basically get the answer.
Yeah, exactly.
Okay.
Yeah, so you just, it's by virtue of the fact that these two are equivalent, and therefore every other segment forever will be. Okay. It's hidden in there that we're only spending the interest. It doesn't look obvious. But I'm going to show you that on the next slide. That's what we're doing. Okay. And the endowment simply represents a fund that the university manages. We have a separate corporation called University Toronto Asset Management. Actually, it was structured separately because the folks in financial services get paid so much that we can't pay them at the university. I mean, they make more than the president does in good years. Yeah. And so they manage the billions that we have with a target of 4% to 5% real per year. And by and large, they've done a good job over the last 10 years. Okay. So 167 will do it. Now you might say, well, is that really spending the interest? Well, what we're saying is that the amount here is enough to fund this. Okay. And wouldn't that mean then that what's left over is enough to fund the next cycle? So what we'd like to do is to show that at the beginning of each cycle we have the same amount of money, which means that 5% will be able to do it over again. And that's really what this next slide demonstrates. So the alums come up with 167 grand. We deposit it, we give it to University of Toronto Asset Management. They set up an account, you do the three-way track meet, and we earn 5% a year. Sometimes a little more, sometimes a little less, but let's say 5% on average. Well, what happens? Well, in the first year, we've got that full 167 earning 5%. We have minor amount of expense in Toronto, which means we have more money than we started off with, earning 5%. we go off to Ottawa, we go off to UBC, and at the end of the cycle, the 3-year cycle, we've got exactly the same amount that we started with, i.e., different formulation, but what we've done is simply spent the interest. Given that we've got 167 now for the next cycle, we can do it all over again. We haven't touched the principal. Okay, that's the nice thing about equivalence. You can't see that from the other calculations, but that's what's happening. So assuming we, on a longer term basis, can earn an average of 5%, we're good forever. Okay. Now, what about if the British Columbia meat work initially was in year 1? I think over a long period of time it really doesn't matter in terms of the sequencing, but really you're taking money out of the fund much earlier, and it doesn't have the ability. There's a $19,000 difference at the beginning of each cycle that doesn't work for the alums in the endowment, and it suggests that we need more money. Well, I'm doing exactly the same calculation, except the timing's slightly different, and indeed what we see is that we need more. We need about $180,000 if the first need is out in British Columbia. Okay, so in that $19,000 difference of the draw initially versus in year 3 makes a difference. Okay, it's just simply not earning that money. Okay. Any questions? Okay. Please.
This will be like a fixed annual deposit, right? Salary will mature interest.
Oh, the 5%?
Yeah.
This 5% is an estimate that is based on sort of long-term performance of, like, this money will be invested in the stock market, in real estate, in bonds, and that mix over a long period of time will return 4 to 5%. 3 years ago, it returned minus 20%, and all of them got fired. But over the long term, on average, because many years, a good year, 8 and 9%, so it makes up for the bad years. Okay. So there's no guarantees. Okay, but we reasonably can expect if we've got good people that we're paying $500,000 a year to manage the money, that they're going to get 4%. They better.
So you giving the 5% for like 6 years or 9 years have what? Multiple of 3?
In what sense? In this one here?
Yeah, like 3, 6, 9, 12.
Well, if you wanted to do 9 years, you'd have to do 3 cycles. So your present value would be 3 cycles, right? And then, let's say you wanted to do a 9. Okay. So if you did 3 cycles of this, you'd find the present value of doing this for 3 cycles. And then you'd want to make that equivalent to 9 years worth of it. Right. So that would be the link if you wanted to do it for 3 cycles. So then this would be 9. But the present value would be almost 3 times that, or less than 3 times that, but almost 3 times that. Okay.
But they'll have the same annuity?
Yes, you have the same number, because what you're saying is 3 cycles, I can now repeat 3 cycles at a time going forward. Okay. And you find the equivalent amount, so it would be exactly the same number. Okay. Okay. Well, I just wanted to, this is sort of a plug for U of T, but an example here. There are many folks that say the University of Toronto is a really rich place. And, we've got all of this money, and why would we possibly ask people for more? Well, perhaps. Let me give you some numbers. And what I'd like to do is to basically, I've got 2007 numbers here. Market dropped about 20%, but we're back up to where we were, and a little bit now. Okay. Let's look at the value of the endowment. And again, this is simply all of the invested funds that have come to the, or all of the donations that have come to the university, and any surplus we made in good years over the years to the university. Okay. And I'm just going to make it in U.S. dollars. Okay. And let's look at U of T. Well, we've got $15.6 billion. Okay. Now let's put that in perspective. Good perspective is, what can we do for our students? Okay. Well, why don't we ask the question, endowment for students? Well, we got a few students at U of T, and this number is $112,000 per student. So when I look out there, there's sort of a cloud of $112,000 above everyone. Okay. Well, the president says we can't spend that, we can only spend the interest. Let's just say we can make 5% a year. Okay. So the income, if you will, for students. Is that okay with everyone? And let's just say we can make 5%. Well, that income is $5,560. Comparable to almost free. So 556 for the endowment, the tuition, and our basic income unit from the government for each student. That's the resource we have to play with. Doesn't look too bad. Only problem is, this is U of Texas. A large, publicly funded research institution, 50,000 students, much like us. What about a U of T closer to home? Sorry, I like doing this. Well, you know, rich U of T's got $2 billion. What's that per student? Well, the cloud above you folks has shrank. 33. A grand total of $1,667 per student. Don't spend it all at once. Big difference. Now, when we're talking rich, let's put a third one into the mix. They happen to have a little more than U of Texas. But they don't have any students there. Per student, the cloud is enormous. $2.2 million per student. Take 5% of that. You don't need a calculator to tell you that's a large amount of money. Can you imagine what I, at New College, or generally anyone at the university, could do if we had every single year forever $111,000 flowing in on top of tuition for each student? Can you imagine what we could do for our students? That's rich. Now, let's just take this totally off the table. Don't even want to talk about it. Why does it seem that our American colleagues seem to want to donate a fair bit more, and this is not anomalous, a fair bit more to American universities, whereas Canadian universities try as we might. We've got a huge department. We don't call them beggars, we call them development officers. And we call it not the vice president of begging, but the vice president of university advancement. We have an army of them. That's the best they can do. Why don't folks donate to you?
More Canadians come from Scottish.
The Scots back here. What do you think?
The government gives us usually more money than it gives American universities.
There's partially that, yeah. Or from a donor point of view, I've already given through the tax system, because we get taxed really heavily here, as we'll show you in Chapter 5. So I've given already. I got nothing left to give. You know, or it could be, you know, we don't have a good football team. There's no really affinity with the university. You know, we're not good at making that link the way the university are in the United States. There's a real sense of alma mater and loyalty, which of course translates into dollars. But we're trying. So this is sort of my plug in. When you get out there and you actually start earning some money, perhaps when you're thinking of charities, we are registered charities, so you can deduct it. Perhaps some of that money will come to you. Okay. Every once in a while, students really, really honest about it. You know, you prostitute and made life's hell for us for the last 4 years. Why would I possibly want to donate to you? I'm going to get even. Hopefully you folks don't think that way. Okay. So anyway, it's amazing what can happen over a long period of time, and the ability to augment your operating budget year over year to do good things for students is a function of, I guess, the generosity of the folks who come before us. Okay, how are we doing for time? Okay, so I just want to make the key point, which will lead into my next lecture topic, is I have modeled this, and I've come up with, I'm going to argue, fairly good numbers by totally ignoring inflation, right, because of course prices go up. But at the same time, in that 5%, I've ignored the fact that the university is going to earn more. Well, how much more? Well, if I say that I'm going to make a real return of 5%, okay, so I'll go back to this. That means that I want to be better off in the sense that I can buy more goods and services 5% more. Well, let's say prices are going up by 3%. Does not the university have to make more than 5% to be better off? Right? Because the money next year is worth 10% less. So the real world view of this is I has to be 5% plus 3%. So University of Toronto Asset Management is making 8% per year. Okay. When I model it, how much better off are we in terms of real? What can we buy? Well, we can buy 5% more. So the two ways of looking at this, I'm going to formalize this in the next lecture, is I can either do it this way, no inflation, or I can say, what's the actual rate of return? 8%. And therefore, these cash flows then would be going up by 3% to reflect the fact that prices are going up. Okay? And my argument is going to be that both of them are equivalent in most circumstances. Life is much easier this way. And as engineers, when we're modeling engineering projects, we will take this approach. But I'd like to show you both approaches and the complexity of dealing with inflation and really what the actual rate has to be. It's not quite an additive thing. It's a cross product to help us model engineering projects. But going forward, this is the way that we will do it. But on Monday or Tuesday, whenever, I'm going to show you both approaches. Then we'll talk about bonds, and then we finally start talking about engineering projects. Thank you so much. Have a great weekend.
去刮子费了不？对啊，就在楼下呢。嗯。